Once you start trading, you need to know the two types of analysis: technical and fundamental. Technical analysis. Sounds scary? Don't worry, we made everything simplified for you. Technical analysis relies on historical price action and computed indicators to forecast future exchange rates. It focuses on charts and patterns. The theory behind technical analysis is Forex history tends to repeat itself. In this example, we have US dollar-yen market. You will notice that whenever the price approaches the 114.064 area, it tends to reverse. This could indicate that it may be a good time to consider selling US dollar-yen the next time it reaches 114.064. Why? Firstly, the last 3 times the price reached the 114.064 area, it reversed. This suggests that we can assume that the price might reverse again. Technical analysis is a popular way to trade in the Forex market. It is also a self-fulfilling prophecy. If many traders all look at the same analysis, they will trade the same way. This means that the fact that everyone trades the same way will push the price in that particular direction. As you can see, US dollar-yen has reversed from 114.064 twice in a row. The next time the price reaches 114.064, thousands of traders will sell because they are expecting a good reversal. Remember, it's important to note that technical analysis is not a guaranteed analysis. If you make a mistake in your analysis, you may end up selling when most traders are buying. However, with practice, you can learn to utilize technical analysis effectively. Fundamental analysis. Forex fundamental analysis focuses on the overall state of the economy. It involves understanding the economic news and uses economic data to predict moves in currencies. By interpreting economic data, you can gauge the strength of a country's economy. For example, if Europe has a strong economy and the US has a weak economy, the fundamental trader may place a buying position. This is because the trader is expecting the euro to rise against the dollar. Typically, fundamental traders will hold trades for weeks or even months. Economic factors usually don't cause immediate spikes in a currency's value. A great example for this is interest rates. One of the most important economic indicators for fundamental analysis are interest rates. Countries that have high interest rates attract more foreign investments. If you had to choose between an interest rate of 0.5% or 5%, you would obviously choose the 5%. Over longer periods of time, high interest rates causes currency's value to rise as people invest in the currency. So if the US had a 1% interest rate and Europe has a 0.5% interest rate, the US dollar may rise in value against the euro. This would mean that a fundamental trader goes short or place a selling position on euro-US dollar pair. Now that you have learned about both types of analysis, you may be wondering, which one is better? In truth, neither is better than the other, as both have their own strengths and weaknesses. Ignoring technical analysis can leave you vulnerable to price movements at critical levels. On the other hand, ignoring fundamental analysis may cause you to be unprepared for unexpected news events that can affect the market. Therefore, it is important to strike a balance between the two and find what works best for your analysis.